Hello, everybody. Today we're going to be talking about portfolio optimization. This is, I'm going to take you through all the mechanics of setting up historical stock data, grabbing that from a source called Yahoo Finance, doing some basic transpositions on the data to get it in a format that's useful, and then we're going to fit it into an optimizing SciPy optimizer model, and then optimize the entire portfolio so we can do two things simultaneously. We're going to maximize the returns of the portfolio and minimize the risk. I mean, there's a trade-off between the two. We can't totally do both at the same time, but we will simultaneously look at all the historical closing stock prices and optimize it to the extent that we have achieved maximum returns or we have minimized risk, but we'll do everything simultaneously. This is pretty cool. This is very interesting. These are the types of objectives that we're looking to achieve: maximize returns, minimize risk. I just alluded to that, and at the same time diversify the portfolio. If you have just one or two stocks in your investment portfolio, this is really concentrated risk. You really want to diversify yourself. So if a couple stocks go up and a couple go down, the downs are offset by the ups and vice versa. But really, if you're concentrating everything into one or two or maybe even three stocks, that's not really even investing. That's just speculation. That's just gambling. Okay, so we're going to try to simultaneously maximize returns and achieve diversification, or minimize the risk that we have to bear, and at the same time achieve diversification of this portfolio. So I'm looking at the Dow 30 components. That's what I have here. This is in a list, comma separated with an apostrophe around each item here. These are all strings assembled into a list, and you can get the Dow 30 here. I'm going to share my notes with everybody here at the end of the video. So you can go to this website. You can see the Dow 30. You can copy and paste it into Excel, append an apostrophe, and then copy the list and paste it into here. That's pretty easy to do. And the same thing with the S&P 500. If you want to achieve even more diversification, you can look at this S&P 500 list. There's the Russell 2000. There's all kinds of indices out there. There's all kinds of mutual funds that you can get data for. ETFs at the end of the video. I'm going to show you how to get leveraged ETF data quickly and easily from the web. So there's all kinds of sources. A couple of main things to point out here is we're using NumPy for numerical processes and scientific calculations. We're using pandas data frames pretty extensively. SciPy Optimize, it's abbreviated as SCO right there. We're using a couple date time libraries to tell the model how far to go back in time to get historical stock returns. This is probably the most critical component here. This is Y Finance. So all the historical data comes from Yahoo Finance. I believe that is sourced from KappaQ, and they have a process where they get it from the stock market. I'm not exactly sure how, but they get Dan prices at the close of the market every day, just after 4 p.m. I think some systems have to update. It's probably not exactly 4, but shortly after 4 when the market closes. They'll run their processes, grab the data, and then you have it the next day. So in this example, we're going back in time 6 months. This is somewhat arbitrary. It could be 3, 6. I like 6 because you capture a lot of the movements, the history of the data, without going back too far. If you go back something like 5, 10 years, I don't think that's very relevant to what's happening now. The market is very sensitive to new information becoming available, changes in energy prices, politics, good news, bad news. It all has an impact on the market rate. So I think 6 months is good. If you go back years and years, I don't think that's very beneficial. Some people like to capture all that data. Personally, I think 6 to 12 is good. In this example, we're going to go 6. So it's going to go relative to today. I'm getting the current date time, and I'm just saying go back 6 months from today. So that's how this works. So we go ahead and run this process right now. We're getting, again, for ticker and tickers, this is the list right here. If I go up here, this list is called tickers. We're going to loop through all the tickers in this list and pull in the last historical 6 months of data. So I'm on this cell. I can hit Control Enter to run it. And we can go up here. We have the Run button, and you have a little run control over here. This is a Jupyter notebook that I'm looking at right now. Okay, so I've got the data pretty fast. 26 months, obviously, if you get 12, 18 months or years and years, it's going to take longer. But since it's just 6, it's going to run pretty fast. We're going to do a couple just, I would call it just sanity checks here on the data, just to make sure everything looks clean and correct. And we're going to look at the price 6 months ago and then the price today, and then just do a quick comparison. Did the price increase or decrease, right? That's all I'm looking at here. So I have my prices. You can see we have some ups and some downs here. This thing right here, the DOW barely changed. Apple started at 187 6 months ago. Now it's at 212. So slight increase, not huge. But we can capture the returns too, right? So in the next cell, I'm going to go here, get the returns. Again, just a quick sanity check to see what we're looking at. So Apple's up 13%. BofA, I think this is Bank of America, down 19. I'm not sure INTC is. I used to know all these things. I forgot this one. Down 51%. So that's a pretty big drop there. Disney, 21. Nike, down 28. Walmart, up 20%. Now, in all fairness, we did have some big market moves in the past 2 weeks. The Dow was down 500 points 2 days. I think about 2 weeks ago and Monday of this week, as of this recording. Monday was down over 1,000. I think it came back just a little bit before the market closed. So there has been a lot of volatility. So, I mean, we're going to see some big drops because we're going back 6 months relative to today. So we are capturing the recent volatility in the market. The biggest winner is M, up 63%. Biggest loser here is INTC, down 51%. So it's all over the place, right? That's why we want to achieve diversification. If I dumped all my money into INTC, like I'm gone. I'm done after a big drop in 6 months, 51%. That's kind of crazy. And I had no idea that M was going to be up 63%, and nobody knows this stuff, right? That's why we diversify our holdings, and let me show you how to do that right now. So we're moving on to do some basic plots and charting here. We are going to plot the movement of the prices for each one of these stocks over the past 6 months. Okay, and we're going to see support and resistance levels too. So the support level is in green. That's basically showing you the support of the overall historical price, right? And the resistance level is where the stock is kind of resistant to break through to the other side. It just can't move beyond a certain amount, and it's coming back down again. So we'll see this pattern repeating over and over with stocks. And they're all going to be slightly different, but the same concept over and over. The resistance is again in the red, and the support is in the green. So it tends to achieve support. It can break through the support, but we're taking an average here where it typically doesn't, and the resistance is really the peak. Like it's not going beyond that. That's the max. That's also known as the high water mark. So we have that for every stock. Then we get down to this point. We're going to do some clustering, and none of this is necessary for portfolio optimization. I'm just showing you a couple ideas that you can use to gain more insights into the movement of all these stock prices over time and try to develop some investment strategies. I'm going to have a couple videos coming out about specific investment strategies. This video doesn't really get into it that much. It's more about portfolio optimization, but in an interim step, as an intermediate step, we're doing a few other exercises over here. So I'm looking at clustering. This is a elbow curve. We're looking for the maximum bend in the curve. It's supposed to look a little bit like an elbow. I suppose it does, kind of. You have to use your imagination, or it doesn't look exactly like it. But we're looking for the maximum bend in the curve, and this is about 4 clusters. So I am setting this, and this is preordained. I did this earlier today, so I know it's set to 4. Where can I see that over here? Oh yeah, optimal clusters is 4, and we're running through 11 iterations of sampling here. So we're looping 11 times to get this curve from 1 to 11. The first is basically no bend, or just to begin. We're not going to have one cluster. That makes no sense, right? We want to see how many clusters we need to choose to see how these stocks are going to be scattered between the clusters, or concentrated maybe just in a few clusters. But we're always going to have 4. It's 0 based, so we start with 0 and go to 3, 0, 1, 2, 3. Those are the 4. So here's the scatter plot showing us the 2s, the 0s over here on the right, the 3, is up in the left. So this is somewhat useful, although you can't interact with this chart, and we're not getting the ticker symbols in here. I just want to show you like a quick and dirty way of doing this with some annotations. But one thing, in the next step, I will get the ticker symbols and the the cluster IDs, because you really need that to understand which ticker is associated with which cluster, right? But one thing that I like about these Jupyter notebooks is that you can do plotting very dynamically. You can zoom in, you can zoom out, you can create interactive charts. That's what this is right here. So if you have sort of a concentrated grouping of clusters, you can zoom in and see all the details here. So I see IBM is cluster 1. TRV is also cluster 1. This is Home Depot, cluster 1. Microsoft is cluster 1. This is Merck. Now this is cluster 2. 1, 2, 2, and 2 again. So if I zoom out, I can just double click and zoom out, and I see Goldman Sachs and M are in cluster 0. INTC, that was the big drop there. They lost 51%. So I think that's why that one is by itself. Highly volatile, we see on the left, and basically almost negative returns, right? So that's the big loser. M is the big winner, and the next closest was Goldman Sachs. If I go back up here, and I'm curious, what was the return on Goldman Sachs? We know M was the winner, right? M, Goldman Sachs is number 2 right there. So less than half of the return of M, but still performed pretty decent, number 2 for the whole bunch of stocks. So yeah, everything is validated at this point. This all makes sense to me. If I print out the tickers and the clustering, I can see how these things align. And again, this isn't necessary for portfolio optimization. That we're going to do that in the very next step. But I just wanted to introduce a couple investment concepts just to whet your appetite, sort of, and to reaffirm what we're seeing in the data, to make sure we're doing our sanity checks and everything looks okay. Okay, so at this point, I'm going to do Control Enter to run this. These are a bunch of functions. I'm not going to get into all the details. This video would take hours, but a couple things to note here is the upper and lower bounds that we're setting. I'm saying that every stock can have an allocation of 0 weights up to 25%. Now I'm doing that to make sure there's the diversification. The maximum or the minimum number of stocks that we can get in a portfolio, if there's 4 super achievers, super performers like INTC, we would get 4 stocks, each with 25%. So if we invest $100,000, we would put $25,000 into each stock. That would be like one scenario. Now that's probably not going to happen. We're not going to have 4 triple M's, but we are definitely going to achieve diversification with the maximum asset allocation of 25% and the minimum of 0, right? So if we have just a dog and a loser, we're going to put 0 in. If we have home run, like triple M, we're going to put 25%. But we set those bounds so we can achieve the optimization and the optimal allocation, okay? So that's what that's doing. That is the maximum Sharpe ratio. Sharpe is showing us the maximum bang for the buck. It's going to maximize, it's going to increase our risk, not maximize the risk. It's going to increase the risk to increase the return. There's always a risk-return trade-off. And this minimum variance is doing the opposite. It's going to choose the stocks with the least variance, but still positive returns, right? So we're not going to look for the loser stocks, but we're going to look for stocks that don't have wild swings and lots of volatility in the price over the last 6 months, right? And then we're going to have the same bound set on the upper and lower side. So this floor would be 0 and the ceiling would be 25, no more than 25%, and no less than 0. You can put negative if you want to do short selling. We're not short selling in this example. You can easily set that to be negative. So a short is when you sell a stock that you don't own, you expect it to go down and buy it back later. That gets very risky. There was one hedge fund that almost got blown up during the, what was that? GameStop fiasco back in like February of 2022 or whatever that was. I'm sure you can Google it. Merlin Capital or Menlin, one of those. They were doing a lot of shorting and they lost their shirts in just a couple of days because GameStop almost went to the moon, right? So shorts can be extremely risky. We're not gambling. We're not speculating here in stocks. We're doing investing. That's the objective here. So I set the functions. So now I can go ahead and call all these functions, and I'm going to create a chart to see what the portfolio optimization looks like when it's plotted out. Okay, so here we have the annualized return, 49.1%, and that is for the maximum Sharpe allocation. So maximum, again, is trying to achieve higher returns and accepting higher risk. The minimum volatility is generating a lot less returns, but look at the volatility, 0.081. Look at the volatility over here, 11.119. So significantly higher volatility and significantly higher returns too, right? And this would be the allocation here. But that's the trade-off, right? If you're going to get higher returns, you have to underwrite higher risk. That's the only way to achieve that, right? There's no free lunch. Okay, here's the portfolio optimization plot. So you can see we have a curve, just a slight curve here from the green star to the red star. The green star represents the minimum volatility. Red star is the maximum Sharpe. The red's always going to be higher than the green, and to the right, you're always going to achieve a slightly higher, well, in some cases, significantly higher return. On the y-axis, we can see the plot, and on the x-axis is the volatility. So again, there's always a trade-off between volatility and basically gains or capital gains here and returns. And one thing I'll mention, don't think I said it already, but I want to put this in here. Like, this is the strategy and this is how it works, but you can lose money in the market. It's a fast-paced thing, and there's no guarantees whatsoever. So this strategy, I'm describing the mechanics, but don't get angry at me if you lose money in the market. Don't try to sue me or whatever, because that's not going to happen. But I'm just explaining fundamentally the mechanics of how to do this. You still have to have like some wherewithal of how the market works. You have to have fundamental understanding of capital markets, investing overall, and some common sense needs to be applied. So this is not investment advice. This is just a description of how to do portfolio optimization. Okay, so let's generate a Plotly chart that essentially replicates what we just saw, but Plotly is nice because it's interactive. You can zoom in, zoom out, mouse over it, and get the details of all these plots. This plot over here is just static. I can basically see what's going on, but it does get a little bit I guess, concentrated here in the middle. Some of these are sort of blending together. It's a little bit hard to make out what happens. I can go see the numbers printed up above, but if I wanted to have a nice chart that represents all those numbers, I can use Plotly for that. I think it's still working. Yeah, here we go. So we've got the results. Took a few seconds there. So now we see the details, right? We see the volatility and the returns. Stock tickers, here's INTC, that's a big loser. Triple M is the big winner. Here's Coca-Cola over here. And then the benefit to this type of chart is you can zoom in and see all the details here. So when you zoom in, this is a lot more user-friendly and certainly much more interactive than this thing over here. They're doing literally the same thing. It's just a different type of chart, right? So here is all the stats of the returns of volatilities for each stock over the course of the last 6 months. Here's the maximum allocation, maximum Sharpe allocation. So these are the top 6 stocks that it picked: Walmart, Coke, Goldman Sachs, Triple M, Apple, and Procter & Gamble. And for the minimum volatility allocation, it picked more. It goes down to close to 0. Remember I said it would go down to 0 as a floor. So if we wanted to get just like 1% allocation, some of these smaller ones I wouldn't even honestly look at. Anything beyond 6 I wouldn't even look at. But if you add these up, this will add up to 100%. If we just focus on this first, Walmart, Coke, Goldman Sachs, Triple M, Apple, and Procter & Gamble, I put those over here. So you will see Walmart, Triple M, Coke, so all the big 6 that the model recommended. And indeed, these returns are pretty decent, right? We see almost 60% for Walmart. Then you go down here. The next highest is Goldman Sachs, 27%. Down to, let's see, Apple. There's Apple here. Oh, there's Apple. And then we have Triple M, I think. And the worst performing was Procter & Gamble. So that's why the model is picking the allocation for these 6 right here the payoff is going to be pretty huge. The risk is not significant, and the return is very decent. Here we have slightly lower returns, but still instant diversification and decent allocation. So if we go look at these, we'll have Coke, Procter & Gamble, Walmart, CVX, I'm not sure what that is, Microsoft, and Verizon. And again, you can see still some decent returns, not a whole lot of volatility, right? Less volatility than before. You do have a couple down stocks over here, right? Because the focus is on minimizing the risk, not finding stocks that have no return, but stocks that have low volatilities and some return. So CVX kind of stuck in here, a little bit surprised, 5.06%, but that's okay. Probably had like the least volatility. If we go back and look at CVX, what was that? Let me just take a quick peek over here. CVX had annualized return of 0.07 and volatility 0.19. That's probably almost the lowest in the group. See, here's 0.19 and 0.10 for McDonald's. So here we lost more money with the same volatility. That's why that one was kicked out. What else? 0.19, can't get any less. That's just about the lowest volatility. Oh, this has 0.16, 0.17. Those are close. So anyways, these made the cut for the maximum Sharpe allocation. So this would be the maximum return for your portfolio and the minimum risk, still with a positive return. So if we look at these stocks, I copied and pasted them over here. We can do a quick summary of these. Let me shrink this thing down a little bit so I can see both together. Walmart, Coke. You know, I'm going to color these two. So if I go over here, here's my Coke. Walmart. There, okay. Apple, PG. Oh, we have PG there. Apple was up at the top, right? Okay. GSKO. So we got Goldman. Oh, we already have Coke. Okay, so if I go here and say this is green is good, let's put these as green. And then we saw KO, PG. I'm going to put this over here. You'll see why in a minute. You know, I can just go over here. I don't think it matters that much. I just don't want the same colors in there. PG, Walmart's. Okay, that's good to see both of these. These are showing up in both lists. That's reassuring because we know that we're having some good stocks from the maximum Sharpe. And if we can minimize the vol at the same time, that's definitely preferable to do it that way. Okay, and VZ, get one more. I'm going to make these orange we just want to have some kind of indicator on here. Color is basically irrelevant. I'm just trying to prove a point here. So if I go ahead and filter now on these colors, here's data, filter, apply the filter. Let's get just the greens. And then I want to see what the total gains were. That minus that, right? Because that was 6 months ago. Oh, you know what? Actually, no, let me do this. Let me just. So these are, I'll operate, I subtract 1 to get the relative change, 13%. Okay, that's good. 13%. The average is 17%. So let's say we have 6. Wait, I thought we had 6. So Walmart, what am I missing? KO, PG, triple M. Sorry, I missed one. Just doing this in real time. I did not plan all this out in advance. So Walmart, got it. And you know what? I'm gonna get all these returns for everything here. Okay, so it's end divide by beginning minus 1 to get the relative return, right? Fell down. Okay, nice. So we got that. And we have 6 oranges. 1, 2, 3, 4, 5, 6. Okay, so I think we're good to go here. So let's say we invest. Okay, let's say we filter these out. The average gain is 25%. We can see that down here at the bottom, 25%. And we would put a little bit more in Walmart. We would allocate 25%, 25% to KO. So equals that times 0.25, that times 0.25, GS 18.4 equals that times 0.184, triple M equals that times 0.169, right? PG is 5 equals that times 0.05, right? Wait, 0.005. 0.0, oh no, 0.05, yeah. 5%, yeah. And then Walmart's 0.25. Wait, did I do Apple? I'm sorry, I think Apple 9%. Yeah, 9.5. 0.09. Fix that, and Walmart is 0.20, right? Equals that. Whoops. Equals that times 0.25. Okay, so here's our true returns. It's not going to be equally spread across those, right? Because we set the upper threshold to 25%, that's the ceiling, and a lower to 0. So average return for these is 4%, but again, pretty low risk, right? If we look at only the oranges, we would have. Oh, let me get everything. Okay. Oh, I know, it's the wrong column. Okay. Not that you took so anymore. So we have only the oranges. I'm not going to do the whole breakdown for everything because as you can see, KO is 19.2%, 15% for Procter & Gamble, Walmart. But the average overall, if we did evenly weight it, like this is a little bit off, but it'd be 7%. So anyways, that's the point of that. That's how you do portfolio optimization. One more thing I'll show you is at the beginning, if you, I'm using the Dow 30, you can get the tickers here. You can feed in the S&P 500, any mutual fund, any kind of ETF. This one I kind of like. This I'm going to share in the comments. I'm going to send out the code. When I post this video, I'll post the code so you'll have everything. You can just copy, paste it, and run it as is. This is kind of nice. This shows you leveraged ETFs. There's about 3,408 we see over here. Most of these are highly leveraged. They're getting 57% return in 1 week. That's pretty spectacular return. 1 month is 79.5. Year to date is actually down. This one is up. NVIDIA, they do AI. If you go back 1 year, you can see what these things were for the 1 year. NVIDIA, again, 180% over the 1 year. So these are pretty highly leveraged. You can make a lot of money very quickly, but you have to be careful with these two because they're leveraged. Here's 3 times the leverage. It says it usually right in the name. Here's 2 times long, 2 times, 3 times. So again, these can be very risky. You can make a lot. You can lose a lot, so you have to be careful with those. But it is another source of tickers to feed into this portfolio optimization tool. And I'll hand over this code when I post this video. So this is just a way to grab all of those tickers that you see based on what 1 month returns. So the highest 1 month return, sorting in descending order. So if you go over here and you run that code, you'll get this for the first 5 pages. So this is page number 1. Here's page number 2, page number 3, up to page 5. You can keep going with this. I just got the first 5. Then you're getting down to smaller and smaller returns. 4.7% return for the past month. So less risk, less reward. That's essentially what that is. And this Python code over here will screen scrape the data from those pages and then put that into a nicely formatted list. So you have all your tickers down here for the first, I think, what did I give you? 50 per page? It might be 25. It might be 25. So you get 25 times 5, 125 tickers into this list. So that's just one more idea to then contemplate. Again, these leveraged ETFs are super risky, so you have to be careful with those. I prefer the Dow or the S&P 500. But essentially, that's it, guys. That's how you do portfolio optimization. We did some pretty cool clustering and overall a historical 6-month return. Again, the date is dynamic. All the tickers that you feed in are dynamic. So you can just copy paste the code, change your dates, change your tickers, and run it as is. So hopefully that was enlightening. Hopefully you learned something new. That's pretty much it. Thanks, everybody. Have a great day.